Dirk Graber, co-CEO, and Irina Zoba, head of IR from Mr. Spex, with us today. Mr. Spex has come up with fairly good numbers last week, and I'm sure, Dirk, you will also give us some insight what happens the last 6 months, and maybe also some insight what you expect in the next 6 months. Some housekeeping points, really. Dirk and Irina will have a presentation like 20 to 30 minutes. That one will be followed by a Q&A. We plan another 20 to maximum 30 minutes for this Q&A. If you want to ask questions, feel free to paste them down in the chat box. If you want to ask them in person, please raise your hand. There's a link on the bottom as well, so I will then get you live here as well. But and the last point, obviously, as always, we will record this meeting. Now it's time to hand over to you, Dirk. The floor is yours.
Thank you for the kind introduction. So thank you everybody for taking the time to listen in. I would start with a few slides and comments on the company and overall strategy. I know probably most of you are familiar with, but only highlighting a few things. I'm not going through the entire company presentation, and really put the focus on Q2 results and give you a view where we stand and what is next, basically, for Mr. Spex. All right. So having said that, quickly jumping to what is actually the purpose of Mr. Spex. All right. So to understand where we're coming from and why we are doing what we are doing. So what we see in the market, and that I would say we've been able to change that slightly, but are not yet done, is that a lot of eyewear buyers still don't like the process of buying glasses. And for two reasons. One is really the process of selecting the right frame that you like and that fits you. And the second one is really about the lens price, lens transparency, lens selection process. And that's why we at Mr. Spex always say we want to empower and inspire people to wear glasses with joy and confidence. What does it mean? So we try to enable our consumers not to be basically depending only on the optician in the store to tell them what to buy, but really enable customers in doing this themselves, but at the same time also giving them advice, giving them help if they want to, and so that they come up with a product that they really like and that they want to wear and have fun doing so. And that's what we are working on in many things, and I will try at a later stage of the presentation really to highlight how different things that we are doing are really paying into that purpose of Mr. Spex. So quickly, 2022 numbers and highlight. We are active in 10 markets online, and 4 out of them, these markets, we're also covering with own retail stores. End of last year, it was 68. At the moment, we have 74 stores. The majority of them clearly is in the German market, our home market, but we also increasing the footprint in Austria. We have 3 stores in Sweden and also opened first one in Switzerland end of last year. Looking at revenues, prescription glasses is already the largest category for Mr. Spex on a full year basis. Sunglasses is a relevant category because in sun is also a huge share of prescription sunglasses, and contact lenses is a category that is mainly basically serviced online today, but it's a good category basically to stay in contact with customers and have the full optical product range available. Last year, we generated revenues of 210 million. As I said, Germany is still being the largest market, but in the mid to long term, we obviously want to replicate the success we've had already in Germany as well. So let's have a quick look at the market. So the eyewear market is a market that is typically very stable, very constant in terms of development, typically shows growth rates of 3 to 4 percentage points a year. You have to basically look at the last 3 years. There are a lot of shakeups, external factors, which caused different numbers, but I would say in a long-term trajectory, we are still on that 2 to 4% in Europe. If you go to Eastern Europe, obviously you see higher numbers. The German market is roughly 6 billion in retail sales, 30 plus in Europe, and the global market is over 100 million. You see basically three general trends in the eyewear market. The one is that I would say you have an aging population, so older demographics need basically to a larger extent prescription glasses, and so aging population leads to a higher share of people that need prescription. The first trend is really that you have a lot of people that use digital devices, so the increase in myopia is clearly a driver for the entire market. So you have certain generations which have, or the younger generations have a much higher basically likelihood that they need prescription glasses today than they had 20, 30 years ago. And the last trend that really plays into our value proposition is that eyewear is today seen as a fashion accessory and a luxury accessory. And I will pinpoint that at a later stage when we look at also the growth within the luxury part of our assortment, which is brand driven. All right, and then maybe quickly looking at who are our customers, right? And what is our growth story going forward? So when we started Mr. Spex 15 years ago, we started as a pure online player, and we targeted the 20 to 40-year-old customers. And here we have already quite a high market share. Why? Because this is the customer age where the eyewear is typically less complex. So you talk about mainly single vision glasses, and you talk about a very online affine customer base. So here, this was clearly what we tackled with our online value proposition. And with adding retail stores at Mr. Spex, we had two strategic, I would say, objectives. The first one was to win more within that core category, because there are still people that don't want to buy the first pair online, and trying to educate them then buy the second pair online. And second is addressing the 40 to 60-year-old eyewear buyers, because at around the age of 45, you see that the share of people that need prescription glasses is increasing, because this is the time when typically your eye muscle is starting to weaken, so you need reading glasses, and people that had glasses before then need varifocal glasses, or you need at least reading glasses as a standalone item. And therefore this age group becomes attractive for a number of reasons. Obviously, the age groups are typically just more people because of the boomer generation. They need to a higher share of prescription glasses, and when you buy varifocals, these glasses are more expensive, so the average order values go up. And that's why with our retail stores, we focus additionally to our core demographic online, also on the 40 to 60-year-old, especially fashion-affine buyer group. So when we look at what is the brand promise of Mr. Spex, what do we stand for? And it's really combining three things. The one thing is, and that is really paying into that initial purpose that I just explained, an intuitive experience. So trying to enable customers to do the journey themselves, and to give them as many tools as possible, and to make the eyewear buying process easy, or we call it ease. Second thing is really our assortment focused on very modern, fashion-oriented glasses, from starting in private label, but nice-looking private labels at very good quality, to luxury independent brands, and not basically only going for high-margin private labels, which is understandable, but there's a huge buyer group that wants to have the selections, that wants to have brands, and that's why we're combining both, and that's why you see our assortment being so huge, roughly 10,000 different SKUs on prescription, over 100 and something brands, more and more in the luxury and independent part. And you see 10,000 different sunglasses as well. And we have the competence in-house to design glasses and sunglasses and then have them manufactured externally for our own brand assortment, and especially for the collaborations with a lot of influencers that we're running. So this style competence, that's a clearly differentiating factor also when it comes to other large retail chains. And third, but not least, is really the optician expertise, because that's something, especially when you go into prescription glasses in the category, it's a medical product, you need to earn the trust from the consumer, that they give you basically the same credit as they would give all the other players in the market, that you're delivering high quality products, and that there is no basically difference between you and the others. So when you go into progressive lenses and so on, complicated lenses, you obviously need to demonstrate that, and that's something we're working on as well. All right, so maybe one last slide regarding company presentation before we go into the numbers. That is really the business model that we developed over time and how to explain it. So we typically, when we go into a market, and that is also true for Germany, we started online. And so we have basically the largest presence online for all the products. We have the most data that we collected. We also have huge experience in terms of customer experience, what is converting, what is moving the needle in terms of online business. We then start to scale, obviously, across a lot of different online performance-based marketing channels. And after having succeeded in this initial product market fit, we always go into brand building, because we believe that in the long run, you need to operate a strong retail brand within eyewear, to not being dependent on basically external gatekeepers like Google, Facebook, or whatever. And so therefore, building a brand is important to Mr. Spex. And that's something we have done in the German, Austrian, and Swiss market, with brand awareness levels of north of 70%, aided, unaided in the 30s typically. And that allows us then really to address more and more customers and build basically this brand awareness level before we go as a next step offline. We typically go into high traffic retail locations to then drive the profitability of the business, increasing the share of prescription glasses, and also win new target groups, as I just explained, with the retail stores to 40 to 60-year-olds. And being able to educate these customers how to buy online the second time, and enabling them to do that with a platform that is basically the same across all the channels, meaning that somebody that left our store and bought something has a customer account with all the data in terms of prescription, but also size, and then being able to repurchase online if he wants. If he wants to come back to the store, fine, but closing that basically loyalty loop is very important to us, and that's something that sets Mr. Spex apart to all the others. So that's just as a quick introduction again for everybody who is new to the business in terms of Mr. Spex value proposition and business model. And now I would like to basically jump to Q2 results. So in Q2, we really, I would say, showed again a nice outperformance versus the market, and in a market environment which isn't easy, to be fair, right? And we come to that in a second. We executed on our Lean for Leverage program that we put in place last September, and we also, I would say, made good progress in delivering on our brand promise. Again, we showed revenue growth of 10% in the second quarter, first half year 8% year over year, and significantly worked on the bottom line to improve profitability, to get back to 0.7 million adjusted EBITDA in the first half, which is an improvement of 4.7 million. We even showed positive EBITDA, not adjusted, but EBITDA in the second quarter, overall also improving significantly our operational cash flow. Right? So that's as highlights. We're going to go into all the details now. So I would say we see that the market in eyewear, especially the online-driven, digital-driven one, still shows a very sizable opportunity for us, and we're consistently working basically on that to grab more and more of that share. Right? And we continued to develop our brand strength. I mentioned building a very strong retail brand is important to us because we believe in the long run it's the driver for profitability. And so looking at the market, we always look at GfK data, which is a good indicator, basically the consumer confidence index of GfK for the German market, to look at basically how much demand is there. We've seen that, I would say, good improvements from very negative levels in Q4 last year to levels which are, I would say, somewhere comparing to March, April last year, but at the moment it's stagnating or even slightly reducing and worsening again. Right? So second quarter was okay, but looking at the third quarter, also for the outlook, it's, I would say, the whole thing about German economy not performing well is also reflected in a slight reduction again in consumer sentiment. We outperformed the market in the first half. I mentioned that on the right-hand side, you see basically the market growth in prescription and sunglasses versus Mr. Spex. So here, I would say a very solid performance against the market. Also, when you consider these are units, and there's an additional component basically coming from average order values, which we're going to talk in a second. So here you see the development of our retail sales of our stores on a comparable basis. So we made good progress in terms of sales on the left-hand side, also compared to prior years, right? So which is always important, having a solid like-for-like growth on a retail portfolio, and on the other hand, also improving the overall profitability of the stores, which you see that's the average EBITDA per store after rent. So how we manage basically our retail stores. And so which shows a significant improvement on a much more constant level versus prior years. I'm coming to a number of actions soon, how we've done that, especially when we look at the Lean for Leverage program. Overall, as mentioned on the left-hand side, the retail stores in the first half of 2023 made up roughly 30% of sales. Last year, Q1 being impacted still by COVID measures, especially in Germany, it was 20%. All right, just talking about Lean for Leverage, there are three components that we communicated last September, how we want to improve profitability substantially and get to cash flow break even rather sooner than later. So first one is concentrate on the core. And that meant we gonna focus on our DACH market. So Germany, Austria, Switzerland, where we have this high brand awareness, and we focus a little bit more on existing stores rather than an extensive store rollout. So we've seen in Q2 a 6% like-for-like growth. First half in total was over 10%, so double-digit like-for-like growth on the entire store portfolio, which is good, and which I would say shows also a good recovery versus the COVID years. And the second thing we work on here is to flexibilize our work contracts to basically have a better management tool for demand patterns, which in the retail is really focused on Fridays and Saturdays. So that's something which we've done and which allowed us basically to also overall reduce HR spend when it comes to retail in percent of sales. Second thing is really to optimize margin, gross margin. Here we've seen significant uplift again in the second quarter on a year-over-year basis. This comes down to lower discounts, which I'll show you in a second. And we also introduced a price for the standard lens that we, until April this year, typically included for free in our offers. Here we decided to change that and try different price points. At the moment we are there with 19.95, and it showed good results and increased again profitability. On the right-hand side, really focusing on operational leverage topics. So we basically streamlined our headquarter organization over the last 9 months, making active FTE adjustments to reduce overhead costs. And on the other hand, we decided to introduce the lean management philosophy, really coming from the operations automotive part many years ago, but starting with operations, also operations at Mr. Spex, and then transferring that also into the headquarter functions. So we already trained more than 20% of our employees, all the head ofs and leadership teams already trained. So, and we're making good progress there in terms of productivity improvements in operations. But later on, we want to increase also productivity substantially in the overhead part. So looking at margin, I said it, so we reduced actively discounts and campaign incentives, plus we adjusted price points to increase our margin profile. And we also saw the product mix shifting to a higher margin mix, especially with contact lenses, with a deliberate decision to focus more on profitable sales. So that came at the expense of slightly reduced sales in contact lenses, but overall sunglasses picked up that share. So we increased here also our margin. All right, looking at the next one. So that's on the left-hand side itself should look familiar to you. So what did we do on our strategic things or initiatives? On the one hand, ease. We continue to invest in technology, and one of the key elements here is really our face measurement app, where we allow customers to use it to get a better recommendation in terms of size for prescription, but also sunglasses. That helps us to drive down return rates, but also increases the confidence of consumers and therefore conversion rates. The second level of that is really working in our bespoke frame portfolio. So these frames are bespoke, so custom made for our consumers after a face scan in one of our stores at the moment. And so we sell that at $249 for the frame plus the lenses. And we're rolling this out more and more, and it shows really good unit economics and also a good customer adoption and a great feedback from the consumers. So this is something unique at Mr. Spex. Second, on the style perspective, we actively working on the portfolio of brands. We added 6 brands in 2023, including Maui Jim, which is an iconic sunglass brand. So we just added it in August. So the full impact we will see next year, to be fair, because sunglass season is almost over. And the expertise side, we had our 15-year anniversary campaign, really focusing entirely on optician expertise, also getting basically good feedback from consumers, but also showing good results financially on that. So looking at the financials for Q2, I mean, I don't want to repeat everything, but maybe highlighting here the strong cash flow that we've seen in Q2, plus 13 million, ending half year with 124 million in cash and cash equivalents. That's something which we are proud of, obviously. There are some seasonal elements in it, to be fair, on working capital improvements, but overall, that clearly led to us confirming the guidance that by year end, we aim to finish the year basically with 105 to 110 million, but we're coming to that in a second. Looking at our revenue split on a quarterly and half-year basis, you see on a half-year basis, basically prescription glasses, a good growth development, plus 13% versus last year, just 1%. We had a very good start into the sunglass season in the first half, so plus 18%. That's partly seasonal, but overall a good development. Contact lenses, I mentioned, we focused more on profitable sales, so therefore certain products, certain channels that didn't deliver our minimum targets, basically we decided not to continue, and therefore we also saw a reduced sales number here. But that was a deliberate decision to overall have a more, and I would say, higher margin product mix. And we opened 3 additional stores in the second quarter. Now, as I already mentioned, having at the moment 74 stores operating. The boutique segment, that is basically the luxury and independent part of our assortment, grew 58% in the second quarter, showing a very strong development again. And we saw, I would say, slightly lower numbers, but high numbers in prior quarters already. So that push basically in a market where you see low consumer confidence is the right one, because the luxury and independent segment seems to be very, very solid, and even demand is increasing at the moment. If we look at our market development, so as I said, we focus on Germany. So here we showed 14% growth in the second quarter, and added 2 new stores, 1 international, which has a higher share of contact lens sales, contracted by 2%. We, next to the contact lens general discussion, we're having also some headwinds from the FX rates in the Nordics. If you look at Swedish and Norwegian krona, they devalued significantly, and therefore on a constant currency, it would be plus 2%. So where are we getting the operational improvements from? If you look at basically first half year, you see the highest or largest driver for the improvement of the adjusted EBITDA is gross margin. So it's all the whole thing about pricing, lower discounts, and so on, combined, plus the product mix, delivering 290 basis points. Personnel expenses slightly increasing because we have, on a year-over-year basis, 14 additional stores, which basically we try to compensate by overhead cost reductions, but overall there are more people in 14 stores, and therefore we see a slightly increased share, because the overall personnel expense in terms of % of sales in retail is higher than in the overall business. Marketing expense, we reduced by 160 basis points in the first half, which I think is a very strong result, especially when you look at the top line development of 8% overall. And operating expense here come, I would say, other cost measures that we've taken in other costs, plus also the, I would say, improved productivity data that we see by increasing the AOVs in place. So overall, we improved the adjusted EBITDA in the first half year of 2023 by 430 basis points. Right. Here you see basically slightly more detailed levers and improvements. I would say, in the interest of time, go over that to leave more time for I would say questions. I would say cash flow. You see the operating or the cash flow from operating activities really stands out with 18 million plus, investing cash flow -4, and financing -3. As I said, strong development, partially seasonal working capital effects, but which basically, looking at the second half, we see that market environment is not easy, right? But with I would say the things we are put in place and that we are working on, we believe that overall we see that we can confirm our guidance. I come to that in a second. If we look at it at gross profit, we see basically that we're working on continued reduction of the discounts. I mentioned it. The share of prescription is increasing with the higher number of stores. And the headwinds is really, we see that our competitors over the last 2 to 3 months actively invested in a lot of promotions, especially on price. And we've seen also that while Q2 gave us some good, I would say, tailwinds on sunglasses, Q3, to be fair, especially in the German market, wasn't the best weather for sunglass sales, so there are some headwinds here. On a personal expense side, we further streamlined, as I mentioned, headquarter functions to gain some, I would say, savings. On the other hand, we will open 3 additional stores in Q4. We signed all of them, so ending the year then with 77 stores at Mr. Spex, if everything goes on plan for the opening of the stores. And we see some headwinds, obviously, from the continued cost inflation of HR costs. They're slightly reducing year over year, but still they are there, right? And on the operating side, we continue to implement our Lean for Leverage program, including the lean management philosophy, and also we work on marketing effectiveness in the second half. On the headwind, obviously, when we see some headwinds from the market in trading, then there is some, I would say, risk of operating deleverage as well. So looking at the full year, we confirm our net revenue guidance of being mid to high single-digit growth numbers versus 2022. On EBITDA, we want to achieve a low single-digit % margin on adjusted EBITDA, and on cash flow, as I mentioned, we want to finish the year with 105 to 110 million in the bank. So having said that, I would say let's move into Q&A. I saw some of your questions already, so I will try to answer them now, but I haven't been able to multitask so perfectly to answer them already all in the presentation.
Don't worry, maybe I can guide you through the through the question, and maybe I can bundle some of them. But first of all, thank you very much for this very insightful presentation. Quite a lot of details. Maybe just one quick question from my side. You know, we are also covering Fielmann here at Alster Research, and what we could find out is that obviously you're gaining market shares here in Germany. Who else are you competing with in Germany, and who do you think is the most aggressive one? And there's also one question in the chat box which asks what sets you apart from other players, especially from Fielmann and Brille.de?
So first of all, what sets us apart? I try to explain basically positioning, assortment, and also I would say the technology angle. So maybe the most easiest one to understand is really assortment, the fashion focused part. So while a lot of players, including the ones you mentioned, focus heavily on private label, so 80-90% of sales, for some players it's even 100% of sales are private label products. There is a huge demand for branded products, for independent luxury brands, and none of the large retail chains really offers that at a larger scale. And we are the retail player that really offers these brands a platform to basically be present in the entire country, in the German market, and to also reach the attractive customers of for the luxury brands. So today, luxury buyers are not 65 years old on average. They are really, the younger demographics are buying more and more luxury products, and also the ones that love their eyewear, which we call the eyewear lovers, which are more the 40 to 50-year-olds. And here, I think the assortment clearly sets us apart. The other thing that sets us apart is pricing. So we're significantly more transparent, and in a combination of the frame and the lens, we also offer the consumers an attractive saving versus the 2 other large retail chains. And maybe the third one is that on the technology angle, we always try to basically work on the customer experience to make it more, I would say, we call it ease, but also fun. So people not hating their purchase at the optician, but really loving it. And because then we believe we can increase also the net promoter score and the stickiness and the loyalty of the consumers. And with basically the apps that we already developed in the App Store, but also the custom-made products, which basically deliver you a significantly better experience because you have the one that you like and which perfectly fits you in terms of shape, nose part, but also size of the temples and so on. That's something that clearly sets us apart.
Perfect. Thank you very much. Talking about luxury, I think if we just step into the first question, which asks, Q2 was dominated by sunglass sales. In terms of product mix, what can we expect to see in H2 and how will it affect gross margins? It's probably more like a seasonality question, I suppose.
Yeah, so if you look at our last year's numbers, H1, H2, you see typically is the gross margin in % of sales slightly higher in the second than in the first quarter. That is because the share of prescription glasses in the second half of the year typically is higher. And therefore, you will see basically slightly improved gross margins versus the first half. And the year-over-year gross margin improvement we expect to, I would say, slightly reduce in terms of delta, but still improve it versus last year because we started basically with the Lean for Leverage program and the focus on gross margin in September last year. So there will be a certain year-over-year effect which we run against. But overall, we still try to, or working on basically to improve our gross margin versus H2 last year.
Okay, and the follow-up question was here, which says you had 124 million cash on your bank account, and you were operating cash flow positive in the first half, but at the same time you stick at your year-end cash guidance. Is that conservative also in relation to what you just said about gross margin development in H2?
I would say it's not conservative. So it's, I would say, realistic in terms of guidance because we, I mean, yes, clearly we're working on working capital as well. But in this, I explain you maybe one effect which makes it easier to understand. In the second quarter, you typically have a very high turnover in terms of sunglasses, as one of the colleagues already mentioned. So the inventory turn of sunglasses in the second quarter is the highest. You therefore increase, obviously, your inventory turn, which increases your payables. And therefore, you have a certain working capital effect. This will slightly basically reverse in the second half. And therefore, we believe the 105 to 110 is realistic.
Okay. I think the next question you more or less already answered in the presentation in terms of new branch openings. What is the aim for the rest of the year? So you mentioned 77 by year end. And do you already have a guidance for 2024? And maybe to add to that question, in terms of geography, where can we expect the branch openings to happen?
So we will focus on the branch openings in our core markets, so Germany, Austria, Switzerland, as I mentioned. And so we don't have an exact number yet for next year. I would say the working hypothesis is to have something similar, basically, as in 2023.
In terms of total number, yeah.
Number of new stores.
Yeah, okay, very good. The next question is fairly complex. Maybe I can split that into different parts. Can you give some insights on the expansion of your store network? Which KPIs do you monitor most closely?
So before we open a store, we always look at a number of criteria for the location. So generally, basically, we look at where our existing customers are living because we have already a few million customers in the German market, also in I would say the other markets where we're in with physical presence, we know where our customers typically live. And second, and we go where our customers are living. So basically, strengthening strength is basically a hypothesis here. And we look obviously at overall attractiveness of cities in terms of GDP per capita, in terms of how many people are living there, how central are certain shopping locations. So is there a high level of centricity? So basically, everyone is going into that one location, or is it very split? And we look at traffic numbers for the micro locations, and how much do we pay for a micro location there, and what is the environment in terms of, are there similar concepts or retailers which typically have, I would say, we have positive experience with in the micro locations. So that is basically the general decision-making part. When we look at new stores that we open, we look obviously on certain KPIs like traffic, new customer share, revenue, and so on, capture rate, conversion rate, but also we look at Net Promoter Score. So are people happy with the store personnel, with processes, and so on? So these are, I would say, core KPIs we look at.
Can you give us like an absolute number how much a new store opening might cost? I mean, obviously it's a difficult question depending on the location, but maybe also what's the time to break even on EBIT level?
Yeah, so the investment, so the capex per new store are somewhere around 330,000 euros on average. That, as you mentioned, sometimes depends on the location, sometimes a little bit more. On average, it's that number. So I would say prior to COVID, the break even on a cash basis was around 2.5 years. With COVID, that basically extended significantly, and now we are improving again, but we're not yet at pre-COVID levels. But on an operating basis, I would say we're trying to be cash flow positive, obviously within 6 to 12 months latest.
Yeah. So the last part of this question, probably we could do the math on our own, but maybe you have the number at the top of your head. What percentage of stores do you expect to reach profitability versus the need for closure relocation?
So when we open a new store, we obviously make thorough due diligence and expect basically all stores to be profitable, right? Nevertheless, sometimes, and at the moment, I would say it's a very small single-digit number that we know or have basically on our list to close. But it's not something that I would say we don't have this portfolio approach saying let's open 10, and if 8 are good, that's fine, right? So that's not what we are aiming for. So we aim for 10 stores that are all profitable. But I said over time, so for instance, during COVID, we had 1 or 2 shopping centers which are, I would say, went into a negative spiral there. And we don't expect these shopping centers to come out of that, and therefore aim to close that stores. And we have 1 additional high street store where we, I would say, are not happy with the performance and expect that to close.
Maybe we skip the next 2 questions for the moment and jump into the question which is kind of related to the topic we were discussing. Is it right that you have scaled down internationalization recently, and what can we expect going forward?
So I would say we have not scaled, so we have not cut any countries or so on. But what I explained, we're focusing at the moment on the German, the Austrian, and Swiss market because these are the markets where we have the highest brand awareness. So the return of investment on marketing spend and the overall EBITDA are the highest in these countries. So adding basically sales in these countries typically come incrementally at higher profitability levels. Knowing that in the long run, we want to also grow internationally further, and we will, once we reach cash flow break even, restart to heavily invest in international, but staying cash flow break even. At the moment, We are in some countries where we have scaled down our brand investments, right? That's true, and to reach cash flow break even faster.
Perfect. Maybe we can shift topics a little bit. The question here has been asked, why did Essilor enter with 11% of the shares and what is their plan? And maybe you can also add, do you have any benefits on the operational side that Essilor is one of your major shareholders as well?
So maybe just a quick update on the history of that investment. So initially, the investment was done 2012, so 11 years ago, by Luxottica, when they were still separate companies. At the time, I think it was very helpful for us to learn many things about retail brands and secure basically also our largest supplier at the time. I think at the time we also had some beneficial terms helping us basically in the first years. Today, we grew into that terms and we have, I would say, arm length principle, all arm length contracts with EssilorLuxottica. So therefore, I think we have a close relationship to them. They are obviously a shareholder, but also the one of the main suppliers. I think regarding to our size, we have a good integration in their supply chain on the frame side, but also on the lenses side. But we also work with Hoya as a second lens supplier. Therefore, I would say always look where do we get basically most competitive pricing and service levels as well. And next to the, I would say, history quickly. So Luxottica, as I said, invested 2012 initially, and then in the IPO process, they also been a cornerstone investor with 50 million. That was already as a combined business, EssilorLuxottica. So increasing then the stake to 11%.
And do you see any movements in that shareholding up and or down recently?
I think there hasn't been any change in number of shares since the IPO.
Okay, perfect. The next question might be a little bit tricky, but still it has been raised here. What do you expect? When do you expect to become EBIT positive? And maybe if that's a question we cannot really answer, could you give us an indication what kind of gross margin levels do you expect in a steady state going forward?
So in the midterm to long term, we expect EBITDA margins of north of 15%. We call it always low teens, right? So that is basically one of the targets we're working towards. And I would say EBIT, so at the moment, we really focus on cash flow to get cash flow break even first. And which in the long run also requires basically EBIT being positive, right? So I wouldn't give you an exact number or year at the moment, but at the moment it's really about getting cash flow break even, and from there on basically staying like that, which would require a positive EBIT also.
Very well, thank you. Maybe just a reminder to all investors, if you have more questions, please just put them into the chat box. We have a couple of more minutes left, and I see there's one larger topic which we can still cover. That's all about customer acquisition costs and customer lifetime value. Maybe we start with a last question in the box. What is your estimate of customer lifetime value? Which underlying assumptions is your estimate based on?
So we have a customer lifetime model, which in eyewear, typically you need to have on a quite long, basically, time horizon, because we have a 5-year CLV model, and which includes basically all product categories. We have it by product category separately, but also the cross-selling part. And we, against that, basically have a customer acquisition cost model. So we don't disclose a lifetime value, but I explain you how we manage it and how we measure it. And why do we need basically quite long lifetime value? because you have in the German market a repurchase cycle of prescription glasses, which is north of 4 years. And so if you have a too short time horizon on your CLV, you miss out basically on customer really being loyal to you, and which is a key element, obviously, in eyewear retail. So even if a customer is happy with your purchase, it doesn't mean on average that he returns within the next 3 to 4 years. So we cut this down, this repurchase cycle already, and working actively on that. And we obviously measure also how are we able to sell a pair of sunglasses with prescription or contact lenses plus the sunglasses, and so on and so on. So therefore, we see basically a good development over the cohorts and also over time in terms of CLV. We manage our customer acquisition costs for prescription and sunglasses in a way that we always want to be first order profitable. So customer acquisition cost needs to be lower than CLV and or maximum break even on the first purchase. But then basically we accumulate additional CLV over the 5-year period. We typically see something around 2.5 to 3 times of the customer acquisition cost over a period of a 5-year time horizon. With contact lenses, slightly different, because contact lenses customer purchase 2-3 times a year, depending on the size of the box and so on. And here you basically need to, or we invest up to 12 months, for instance, of CLV to acquire a customer, but you can track and monitor basically the CLV development significantly more closely and have less risk in the time horizon because you can see basically repurchases coming in. So that's the way we look at CLV. What I would say is interesting, obviously, is always the share of new customers. So there, the retail stores show a significant impact, acquiring a lot of new customers and basically increasing the absolute overall CLV because we get into all the demographics, we get new customers, and we get higher AOVs.
Okay. And related to that, not 100% sure whether you partly answered that question. Can you talk about customer acquisition costs versus customer reactivation costs using different channels? And maybe related to that, cost of lead generation versus customer conversion?
Yeah. Okay. Yeah, sure. So, I mean, in the end, it all comes down to a good, I would say, measurement and media mix modeling, as we call it. So you look basically at which channels bring you the most new customers and which channels do you get basically more returning customers from. And so that's, you need to do the math basically across your customer journey with different touch points. And we do that basically to understand which channels drive basically retention or basically people coming back to us versus which channels drive new customers, and then calculate basically customer acquisition costs versus retention costs by channel, and then deciding basically where to invest, which channels for how much, and product category, which is different sometimes. So we do that obviously, and you need to know that obviously the media landscape is changing over time. So while 15 years ago, Mr. Spex started to be on TV significantly to drive the brand, but also being able to measure acquisition costs and new customers, that obviously over time led to more social and influencer marketing and so on and so on. And on lead generation, yes, we also obviously measure that to understand which leads, especially obviously eye exams in the stores, which value do they have and what is the conversion behind it, and what drives basically overall sales and new customers again. So we do all of that, but we don't disclose the numbers, to be fair.
A very detailed answer to a very detailed question. So that brings us to the last part of this question, which is also related to your marketing spend. How do you decide on incremental marketing spend and marketing mix, marketing spend on lead generation versus brand building?
Oh, I would say I'm not the expert in that. So next time we need to ask either our CMO, Davide, or my co-CEO Mirko, who are the expert in that. So here I probably can tell you much better on technology, operations, and so on. I think we have a very skilled team on that, and which I would think is able to decide on that, but I'm not the expert, to be fair. But if you want to learn more, reach out to Irina, and we can also schedule a call if required.
Perfect. We appreciate that. We will follow up on that and see whether we need more information on that, and then we will reach out to Irina. Well, I don't see any further question in the chat box, and I see that we have almost done our 60 minutes. Spot on. So thank you very much. Dirk, Irina, thank you for giving us the insight into your company. Very exciting times ahead for you. Maybe some final words from you. Maybe
No,
what's the next data point which we can expect?
Overall, obviously, thank you for the attention, for participation. You will see, Irina, correct me if I'm wrong, I think November 9th, we're reporting Q3 results. So we're obviously working on gaining more market share and also putting the Lean for Leverage program in place to basically continue the path we're on at the moment. And I would say that current results give us confidence that we're on the right track for the long run. Although the market sometimes is not easy, I would say we have a good structural setup, a good brand positioning, and I think the customer feedback that we're getting really confirms us on a daily level.
Great. That's a nice closing remark. Thank you very much. Then enjoy your evening. Thank you very much again, and see you soon.
Thank you, everybody.
Bye-bye.